Are gold and silver setting up for a full market collapse? Something is happening beneath the surface of the financial system right now. Something most investors are not being told. A quiet rotation, a currency under strain, a pattern forming on the charts that has appeared only a handful of times in the last 100 years. And each time it appeared before, a major shift followed. Central banks are moving, currencies are cracking, and the relationship between stocks and precious metals is beginning to shift in a way that history says cannot be ignored. By the end of this video, you will understand exactly what this pattern means and why the next few months may decide who protects their wealth and who does not. Stay with us until the end, because what comes next changes everything. Welcome back to Precious Metals Intelligence. If you are new here, this channel exists for one purpose: to help serious, wealth-conscious viewers understand the strategic economic forces shaping the future of money, markets, and precious metals, without hype, without noise, and without shortcuts. Before we continue, we would love to know, where are you watching from today? Drop your city or country in the comments below. It always means a great deal to see how far this conversation reaches. And if you find value in this kind of measured, strategic analysis, consider joining the small but growing community of viewers who follow this channel closely. It helps us continue producing this level of research, and we would be honored to have you with us. Every major shift in financial history begins the same way. It does not begin with a headline. It does not begin with a crash. It begins quietly, in a place most people are not watching. Right now, many analysts believe that place is currency markets. For decades, a small group of currencies have been treated as safe havens. When fear rises in the world, money tends to flow into them. The US dollar is one, the Swiss franc is another, and the Japanese yen has long been considered a third pillar of global safety. But something unusual is happening. The yen has been weakening sharply against the US dollar, reaching levels not seen in many years. To most people, this may sound like a small technical detail, something for currency traders to worry about, but strategic economic historians see it differently. And when a safe haven currency starts breaking down, it often signals stress building somewhere deeper in the financial system. To understand why this matters, it helps to think about how modern markets are connected. Investors and institutions around the world have borrowed money in Japanese yen for years because interest rates there stayed extremely low for a very long time. That borrowed money did not stay in Japan. It traveled across the globe, and much of it found its way into other markets, including US technology stocks. This strategy has a name. It is often called the yen carry trade. For years, this trade worked well. Investors borrowed cheaply in yen, invested the money elsewhere, and profited from the difference. But strategies like this carry a hidden risk. They depend on stability. They depend on the yen staying weak and interest rates staying low. When that stability breaks, even a little, the entire structure can become fragile. That is why the recent weakness in the yen is drawing so much attention from serious analysts. If the currency continues to move sharply, it could force many of those who borrowed yen to unwind their positions. And unwinding a position often means selling assets, sometimes quickly, sometimes in large amounts. When enough of that selling happens at the same time, it can create pressure across markets that seem completely unrelated on the surface, like technology stocks in the United States. This is the first crack. It is not loud, it is not dramatic, but it is exactly the kind of early signal that historians of financial cycles pay close attention to. At the same time, another pattern is forming. Throughout history, capital does not stay in one place forever. It moves in long, slow cycles between different types of assets. For long periods, money flows into stocks, and equity markets grow larger and more dominant in the public imagination. Then, gradually, that flow begins to shift. Money starts moving toward harder, more tangible assets, things like gold, silver, and other physical commodities. These shifts do not happen overnight. They can take years to fully develop, but they tend to follow a similar structure. First, a period of extreme confidence in stocks. Then, small signs of stress that most people ignore. Then, a turning point, often triggered by something in the financial system breaking under pressure. And finally, a longer period where capital rotates away from equities and toward hard assets, sometimes for a decade or more. Many long-term investors believe the world may be standing near one of these turning points right now, not because of a single event, but because several pressures are building at the same time. Currency stress, elevated valuations in major stock indices, a long period of extremely low interest rates that shaped investor behavior for years, followed by rates that have moved sharply higher. Each of these pressures on its own might not mean much, but together they begin to resemble the early stages of a much larger pattern. This is the environment the world finds itself in today. A currency long trusted for safety is behaving in an unusual way. A popular trading strategy built on cheap borrowing is facing new risks. And underneath all of this, a much older, slower pattern may be beginning to stir, one that has appeared before in financial history and reshaped how capital is positioned for years afterward. The question now is not whether pressure is building. The evidence increasingly suggests that it is. The real question is what happens when that pressure finds its release and which assets are prepared to benefit when it does. In the next part, this analysis will step back into history to examine exactly how these rotation cycles have unfolded before and what they revealed about the assets that protected wealth when confidence in stocks began to fade. History rarely repeats itself in exact detail, but it often repeats itself in rhythm. And when it comes to money, wealth, and fear, that rhythm has appeared again and again for over a century. To understand what may be happening today, it helps to travel back nearly 100 years to the late 1920s. At that time, stock markets were soaring. Confidence was high. Ordinary people believed prices could only go up. Then, within a short period, that confidence broke. As stock markets fell sharply, capital did not simply disappear. It moved. Some of it moved into commodities and hard assets, things people trusted to hold value even when paper wealth was collapsing. This was not a random event. It was the beginning of a pattern that would repeat many times over the following century. Long-term investors who study these cycles often describe them using a simple tool, a ratio. Instead of looking at gold or silver by themselves, they compare the price of these metals directly to the stock market. This comparison reveals something that looking at either asset alone cannot show. It reveals the flow of confidence itself. When the ratio favors stocks for a long period, it usually means investors feel safe taking risks. They believe the future is bright and they are willing to put their money into companies, growth stories, and speculation. But when the ratio begins to shift in favor of hard assets like gold and silver, it often means something deeper is happening. Investors are quietly choosing safety over growth, even if headlines have not caught up yet. This exact shift happened again in the 1970s. That decade is remembered by many for high inflation, energy shocks, and economic uncertainty. But what is less discussed is how dramatically capital moved during that period. As trust in paper currencies weakened and interest rates eventually climbed to extreme levels, gold and silver experienced some of the largest gains in their history. Investors who recognized the pattern early protected and grew their wealth. Many who stayed fully invested in traditional markets without adjusting were left far behind. What makes this history important is not simply that it happened, but how slowly it unfolded. These rotations are rarely fast. They can take years, sometimes over a decade, to fully complete. In the early stages, most people do not notice anything unusual. Prices move gradually. Confidence in stocks remains strong. It is only later, once the shift accelerates, that the broader public begins to recognize what has been building underneath the surface all along. This is one of the most important lessons from financial history. By the time a rotation becomes obvious to everyone, much of the opportunity to prepare for it has already passed. The investors who benefit the most are typically those who understand the early signals, not those who wait for confirmation from every news outlet. There's another detail from history that deserves attention. During long periods when stock markets are rising, they can remain flat or directionless for years when measured against gold. In other words, an investor holding only stocks may see their portfolio technically grow in dollar terms, while its real purchasing power, when compared to hard assets, barely moves at all. This is a subtle but powerful point. Wealth is not only about the number on a screen. It is about what that number can actually buy, protect, or preserve over time. This pattern also reveals something about human behavior. During these long transition periods, doubt is constant. Prices can correct sharply, even within a larger upward trend, causing many investors to question themselves and abandon their positions too early. History shows that those who understood the larger structural rotation, rather than reacting to short-term price swings, were far better positioned when the shift eventually accelerated. So why does this matter now? Because many of the same conditions that preceded past rotations appear to be forming again. Currency stress, extended valuations in major numbers on a chart may look like simple lines to the untrained eye, but to those who study market behavior closely, they often tell a story long before that story becomes public knowledge. Right now, a specific kind of pattern has been forming across several major stock indices, particularly within the technology sector. Analysts who focus on price structure describe this pattern as one that tends to appear near the end of a strong upward trend, not at the beginning of one. It is not a pattern of panic. It is a pattern of exhaustion, where buying pressure slowly weakens even while prices remain near their highest levels. This type of formation has appeared before major downturns throughout history. It does not guarantee that a decline will happen. Markets are never that simple, but it does suggest that the balance between buyers and sellers may be shifting in a meaningful way. When enough of these signals stack together across multiple indices at the same time, experienced analysts tend to treat it as a warning worth taking seriously, rather than dismissing it as coincidence. To understand why these patterns matter, it helps to consider how modern markets actually function. Decades ago, most buying and selling decisions were made by individual people, reading newspapers, forming opinions, and placing trades manually. Today, a significant portion of trading activity is driven by computer programs. These programs are designed to recognize specific price levels and patterns and to react to them automatically, often within fractions of a second. This changes the way markets behave once a certain threshold is crossed. In the past, a market might drift downward slowly as sentiment shifted over weeks or months. Today, when key technical levels break, automated systems can trigger rapid waves of selling almost immediately. This does not create the initial weakness, but it can dramatically accelerate it once the weakness begins. This is where the earlier discussion about borrowed money becomes especially important. When large amounts of capital have been borrowed cheaply and invested into markets, as has happened extensively through global currency lending in recent years, any sharp move in the underlying currency can force those positions to be closed quickly. This is not a matter of investor emotion or panic selling in the traditional sense. It is often a mechanical requirement built into the terms of how the borrowing works. When a currency moves sharply, certain positions must be reduced, regardless of what any individual investor personally believes about the future. This combination is what many analysts find most concerning today: a fragile technical pattern in major stock indices, a financial system partly supported by borrowed money tied to a currency that is now behaving unpredictably, and automated trading systems capable of amplifying any initial move far beyond what human investors alone might have caused. None of these factors, taken alone, would necessarily cause serious concern. Markets experience temporary weakness constantly, and most of the time, conditions stabilize without any lasting damage. What makes the current environment different, according to many long-term market historians, is the number of these pressures appearing together at the same time after such an extended period of rising prices. It is important to understand that this is not the same as predicting an exact date or a specific market crash. Responsible analysis does not work that way. Instead, it works by identifying conditions that have historically preceded major turning points and by recognizing that those same conditions appear to be present once again. There's also a psychological layer to this discussion that deserves attention. During long periods of rising markets, investors slowly become accustomed to good outcomes. They begin to expect that dips will be brief and that prices will always recover quickly. This expectation, while understandable, can create a dangerous blind spot. It becomes harder to imagine a scenario where a decline is deeper, longer, or more structurally significant than anything experienced in recent memory. This is precisely the environment in which historical rotations have often taken hold before. Confidence remains high right up until the moment the underlying structure gives way, and once it does, the shift in capital away from traditional equities and toward assets long associated with stability tends to happen faster than most people expect. The technical fragility building in major markets, when combined with currency stress and leverage tied to borrowed capital, forms a picture that many serious analysts are no longer willing to ignore. What this means for gold and silver specifically, and how these metals have historically responded during moments like this, is the focus of the next part of this analysis. Throughout history, gold and silver have occupied a different role than almost any other financial asset. They are not shares in a company. They do not depend on quarterly earnings, management decisions, or promises about future growth. Their value comes from something simpler and older: trust in something that cannot be created out of nothing. This is why, during periods of financial stress, these two metals have often behaved differently from stocks. When confidence in paper assets weakens, whether due to currency instability, rising government debt, or fear about the banking system, capital has historically sought out something with a longer track record of holding value. Gold has played this role for thousands of years. Silver, while more volatile, has often moved alongside it, sometimes with even sharper gains during the strongest phases of a rotation. However, history also shows something that is often misunderstood by newer investors. Precious metals do not always rise smoothly the moment stock markets show weakness. In some cases, during the earliest stages of a major market decline, gold and silver can experience a short, sharp pullback as well. This usually happens because investors who are under financial pressure sell whatever assets they can, including metals, simply to raise cash quickly. It does not mean the long-term trend has failed. It often means the transition is still in its early, uneven stages. This detail matters greatly for anyone trying to understand the bigger picture. A temporary drop in gold or silver during a period of stock market stress is not necessarily evidence against the rotation story. In many past cycles, it has actually been part of it, a brief moment of shared selling before precious metals begin to separate from equities and move independently. Beneath this behavior lies a longer, slower force that many investors overlook: the relationship between government debt, interest rates, and the value of currency itself. When government debt grows faster than the overall economy, it becomes mathematically more difficult to sustain higher interest rates without causing serious strain elsewhere in the system. Historically, periods where this imbalance became severe have often aligned with strong, extended periods of strength for precious metals, as trust in currency and government finances came under pressure. This is not a new phenomenon. It has appeared in different forms throughout the 20th century and into the 21st. Each time the details were slightly different, but the underlying logic remained the same. When the financial foundation beneath paper assets becomes less certain, hard assets tend to benefit over time, even if the path to get there is not always smooth. For everyday investors, business professionals, and long-term planners, this creates a difficult psychological challenge. Markets rarely move in straight lines, and rotations like this can test patience severely. There will be moments when metals seem to underperform, when doubt creeps in, and when abandoning a long-term position feels like the safer choice. History suggests that this discomfort is often exactly what happens before the larger move takes place, not evidence that the underlying thesis was wrong. This is why many long-term investors choose to think in terms of years, not weeks. They are not attempting to predict the exact bottom or the exact day a shift accelerates. Instead, they are paying attention to the broader structural signals: currency stress, leverage tied to borrowed capital, weakening technical patterns in major stock indices, and a debt environment that increasingly resembles earlier periods in history when hard assets outperformed. None of this guarantees a specific outcome. No historian, analyst, or investor can predict the future with certainty, but the alignment of so many familiar warning signs appearing together after such an extended period of rising stock prices is difficult for serious observers to dismiss as simple coincidence. What this means in practical terms, and how decision makers might think about positioning themselves going forward, will be the focus of the final part of this analysis.